The labor market showing signs of resiliency after the September payrolls report showing came in well above estimates at 254,000, while the unemployment ticked down slightly. Joining us now, we want to bring in Gary Cohn. He's IBM Vice Chairman and the former Director of the U.S. National Economic Council. And Gary, it's great to have you here on set with us. Let's start with that print that we got this morning. We just heard from Austin Goolsbee praising it, calling it a very, very strong print, but he was quick to point out that this is just one report. So I'm curious, what is your assessment of the U.S. economy today?
Well, I agree with that. Mm-hmm. And I always remind people when we get the jobs report, this is probably the least scientific data that the U.S. government puts out. This is actually polling data. They call people's houses. Mm-hmm. And that's how they come up with this information. And that's why we see relatively big revisions to employment data month over month. Mm-hmm. So I always say, always take these reports with a grain of salt. But the trend is important, the overall trend of what the employment report tells us. So if you sort of take the last 3 months and average them together, we're about 185,000 jobs, which is exactly about the amount of people entering the workforce. So we're at a good, really neutral place where the jobs being created and the people entering the workforce, they're balancing each other out, which is a good place to be. Mm-hmm. So we're seeing a real normalization of what I would call the U.S. economy. Everything about what we're going through, I think, is normalization. Mm-hmm. Now, in that respect, we all forgot what normal is. We have not lived in a normal economy in the last decade plus. You know, we were in a time where we had zero interest rates, where if you saw an article about the Federal Reserve, it would be, will there ever be inflation again? Mm-hmm. And we go from that zero interest rate, will there ever be inflation again, to an 8% inflation print, and we see rates going up by 500 basis points in a year. Mm-hmm. Now we're starting to get back into what is a normal economy, and I think we have to remind ourselves what a normal economy is. Mm-hmm. A normal economy with like 2% inflation, 4% unemployment, a positively shaped yield curve, all of those things that if you look at the long-term history, you would find to be the normal reality of what our economy looks like.
Well, there is some good news out there, right? We had inflation-adjusted wage gains about to be higher than they were for much of 2019, that era we all love to think back to. Is there a potential that this is just what a soft landing looks like?
I think this is exactly what a soft landing looks like. I think the Fed has orchestrated a soft landing. I think we will continue to see the Fed lower interest rates, although today's print gives them the ability to do what I think they were going to do anyways, which is continue to lower rates, but lower them slowly, methodically. I think we'll get another 25 basis points in the next meeting. We'll probably get 100 basis points over the course of this year. It's interesting, the market themselves.
That's more than what they said, though. They said 50 basis points of cuts this year.
I think we'll get another 50 this year. I think we'll get a total of 100 this year.
Okay.
We're still, that would still take us, we'd still be in sort of the 4% plus interest rates in Fed funds. Which to me is still restrictive based on where you see inflation is. We're still going to be, substantially higher than inflation, so we'll still be in a restrictive place. And I think the Fed has the ability to sort of monitor data. There's no gun to their head to do anything. And as long as this employment data stays where it is, I think this is what we'll see. I think we will see interesting reactions, and I think we've already seen this in some of the yield curves. I think that we are starting to see a re-steepening of the yield curves. 2s, 10s were inverted for a long period of time. 2s, 10s are now positively sloped. I think we're going to continue to see much more positive slope go into the yield curve. So even though the front end Fed funds, which is what the Federal Reserve controls, is going lower, I don't think the 10-year rates and the 30-year rates are going lower. And in fact, they're up dramatically today. And they've been going up even as the Fed has been talking about lowering front-end rates. So I think we're going to go back to a pretty positively shaped yield curve.
Gary, what do you think of the job that Fed Chair Powell has done so far?
So I think if you take it in its entirety, I think he's done a very good job. We can pick on pieces of what he's done. And by the way, anyone can always criticize certain segments. So, but if I look back on the entire, 7 years now, 6 plus years, he's done a very good job. I think I criticized them for being late to the inflation fight. They were thinking it was more transitory than it actually was. But once they got in the game and once they realized they had to become inflation fighters and that part of their mandate was important, they got aggressive on fighting inflation. Now that they see that inflation is renormalizing back to their target rate of 2%, which is the stable price of their mandate, they're looking at the employment picture. So, we started to see employment soften. And look, employment still is softening. There's other data than the employment report. If you look at the JOLTS data, you see that the amount of job openings has come down dramatically over the last couple of years. We're still at a high level. We're still, close to 7 million job openings in the United States, but we were well over 11, 12 million job openings at the peak of the tight job market. So I think that the Fed has done a very good job of shifting from the other side of their mandate from stable prices to full employment. And now they're in the position where they're going to balance those two things out with time on their side.
I want to switch gears a bit and talk about the election, that looming event in the air coming up.
I'm shocked that you want to talk
in November.
about it.
I know it's shocking.
You might be shocked that it took us this long to get to it.
Yes, we had to get your economic view here. But listen, we had that 82-page platform from the Harris-Walz campaign, right? Tons of credits put in there from housing to small businesses. But there are also some credits coming out from the Trump campaign as well for the economy, and the way to pay for them is through tariffs. I mean, are you concerned about, no matter who gets into the White House, there's going to be a lot of spending?
Look, I'm always concerned about deficit spending, because I think at the end of the day, we have to be cognizant of our deficit spending. The largest single item that we have being spent in the U.S. government today is deficit. We're over $3 billion a day of interest service on our debt. It's dwarfing what we're spending on the military. So you think about that. You think about the amount of money we're just spending on interest to service our debt today. It is a stifling number, and it will get bigger over time as the debt builds. We have to think about that. That's one of the reasons why I'm so convinced the yield curve is going to get steeper and steeper, is because of the amount of debt. So yes, I'm always concerned about the amount of debt that we're building up. I think it's very important, and I think both candidates need to understand, and I think some of them do, is that we need to grow the economy. The only way to really deal with the debt problem is to grow the economy. Our debt as a percentage of GDP can go down if our GDP goes up. To me, that is the essential ingredient, is do economic growth. I don't believe we should be in an economy where it's based on a plan of redistribution. I think we should be in an economy where we're based on a plan of economic growth. And we want to provide a system of rules and regulations and regulatory environment where we're encouraging growth, not discouraging growth.
So then, Gary, given what we know, I'm not asking who, just ultimately, just from what we do know right now, from the facts that have been laid out, is one candidate better than the other for the economy, or is there too much uncertainty that still remains?
Well, here's what I think we do know for sure, because as you said, there's an 82-page economic plan from the Harris-Walz campaign. There's a lot of rhetoric from the Trump, J.D. Vance campaign. I think what we know for sure, and this is how I evaluate, we know what the economy looked like for the 4 years of the Trump presidency. We know what's happened in the Harris-Biden presidency. We know what those two economic pictures look like. I think you've got a lot of data to make a decision what economy you like. Now, I'll be honest, I happen to like the pro-growth, the reasonable but sensible regulatory economy that we had during the Trump administration. I think this overly protective, overly restrictive, highly regulatory economy that the Biden-Harris administration has is not beneficial to growing GDP, especially when you keep losing cases in court where you're trying to restrict the economy and your restrictions don't even hold up in court.
Gary, real quick before we let you go, let's talk about the corporate tax rate, right? Sure. And that's one of the things that's being debated. We have 28% on the talk of the Harris campaign, all the way down 15% from Trump. I'm curious, just in your role at IBM, if we do see 28%, what does that mean for larger corporations?
It's bad.
How bad?
It's bad. So look, when we rewrote the tax code, one of the most important things I thought we had to accomplish was that we had to make ourselves competitive with the rest of the globe. Corporations compete around the world. There's many US companies that sell vastly more products overseas than they do in the United States. There's many companies prior to the US tax rate going down to 21% that had the option to re-domicile into another country to avoid paying U.S. taxes. They were inverting their businesses out. It was a horrible thing for the United States to see companies that wanted to be based in the United States leaving the United States for one reason only, to lower their corporate tax rate. We have not had a company leave the United States since the corporate tax rate's down to 21. The OECD average, which is the countries that we care about, the average tax rate on the corporate side is right there in the low 20s. It's 21, 22. It's right in that area. That's where the sweet spot is. We do not want to discourage companies from being based in the United States and paying taxes in the United States. We also, in that tax change, forced companies to pay U.S. tax for offshore earnings. And we forced them to bring back, we didn't force them, but we encouraged them to bring back offshore earnings. I think the encouragement, and we encourage them by deeming a tax on their offshore earnings. By deeming that tax, an enormous amount of money came back in the United States. Hundreds of billions of dollars came back in the United States. And that money is being reinvested in the United States. And that's one of the basic reasons I think our economy is so strong. I think a lot of people have missed that point.
All right, Gary Cohn, we got to leave it there, but really appreciate you making the time for us. Thank you so much. Again, IBM Vice Chairman Gary Cohn joining us here in studio.
Thanks for having me.
Thanks, Gary.